So thank you for joining this webinar from Yellowstone Advisory. Today's company presenting is Oakley Capital Investments, who released a very positive trading statement on the 27th of Jan, with NAV increasing 18% to £4.03. And we're delighted to have Stephen Tredget here, who's a partner at Oakley Capital, and he'll introduce us to the company and update on corporate performance. Whilst we're waiting for everyone to arrive, please could you respond to the poll on your screen? And before the presentation commences, I'd like to just go through a couple of points. You're all currently on listen-only mode, but if you do want to ask a question, please type it into the chat box. We've had a few questions sent in ahead of time, and we'll cover all questions at the end of the presentation. Today's format is a presentation from Stephen, and that will last about 25 to 30 minutes, and then we'll hand over to Q&A at the end. Following the presentation and questions, you're going to be directed to a short survey, and it'd be really appreciated if you could spend a few moments completing this. Just looking at the poll responses now, it looks like we have a roughly 50-50 split between shareholders and non-shareholders. So it's great that we've got some new people coming to the company today. So I'm now going to hand over to Stephen Tredget, partner at Oakley Capital, to start the presentation. Stephen.
Hi, Alex. Thank you very much for hosting us today. I will bring up the presentation, which hopefully you can now see on your screen. Thank you very much for those watching and joining us for today's webinar. As Alex briefly covered there in his introduction, my name is Stephen Tredget. I'm a partner at Oakley Capital, which is in the business of managing private equity funds. And the public company we're here to focus on is Oakley Capital Investments, or OCI, which invests in the funds that Oakley manages and allows private investors like you or I to gain exposure to private equity returns through the stock market. So OCI is a direct PE vehicle committed to one manager, similar to a 3i, an HDT, or an Apex Global, and in contrast to a fund of funds who commit to kind of multiple managers. Now, you're going to have to forgive me, obviously, with a wide variety of 50-50 of shareholders and non-shareholders. The first part of this presentation, I'll attempt to really kind of cover off some of the background to kind of why invest in PE and what Oakley Capital does. But rest assured, to those that are shareholders, I will get on to cover some more ground about how OCI is performing and what our prospects are for the year ahead. So just particularly for those less familiar with OCI, to give you an immediate flavour of the type of business that OCI gives you access to. Here is an Instagram shot we scraped last month, which was posted by a student studying online. Now, it's not an obviously groundbreaking event, given what's taken place over the last kind of few years, but notably, the student is in Japan. They're studying an English language career-orientated degree. And it's a course designed to be delivered online by a German university, IUBH, which, as you'd imagine, is held with a majority stake within the Oakley funds. And the key is it's a study program designed specifically for this channel. So unlike a lecturer trying to teach over Zoom, it's completely flexible, student-orientated learning. And it's one of the largest and fastest growing universities in Germany, and it's just one of many examples of digital businesses that make up the Oakley portfolio companies and that have particularly benefited from COVID-19 accelerating technology trends, with digital tools becoming increasingly kind of popular B2C and B2B solutions. So I said the kind of three areas that we covered off. So kind of why private equity, if you've not exposed to this asset class, should you be? Secondly, what's Oakley Capital about and how, what's its investment strategy and how does it source investments, which continues to be a hot topic as valuations rise. And then finally, and most importantly, what's the OCI opportunity and what's the impact of COVID-19, positive or negative, on the portfolio companies. So starting off with the first of those, kind of why private equity. And I guess at a high level, the three reasons that I'd offer are: one, the returns achieved to date by this asset class have been superior and attractive. Secondly, unlike public market investors, PE investors play a significant role in the creation of value, so have significant or more significant control over outcomes. And thirdly, it kind of captures a larger pool of companies. So you're presented with a much greater investment choice and opportunity. And to that point, the kind of chart on the screen demonstrates that. The stats are from the US, but it's played out kind of globally. You'll see in the lighter green line there, the growing number of companies backed by private equity over the last 10 years, and in contrast, the shrinking pool of companies on the stock market. So why are companies remaining private, or at least remain private permanently, or at least staying private for longer? I'd offer three reasons for that. One is that there's just a lot more private capital available. 10 years ago, this was a fairly nascent industry. Two, a PE investor doesn't just offer a business owner capital, but it offers it support, skills, expertise that essentially assist that business in its development and growth. And then thirdly, in contrast to the public markets, which is burdened now by increasing compliance, increasing cost, M&A restrictions, controls around management incentives, the pressure of live pricing, and the market short-termism that I think accompanies that. But also, I think most importantly, as a company, you give up the information advantage that you retain as a private company. So to demonstrate whether or not PE returns are indeed attractive, then to represent public market performance, it's crude, but I'm using the FTSE All-Share over 1, 5, and 10 years as a proxy for PE performance. And I've got the global private equity benchmark, so that's all the funds globally, and you'll see the superior returns they've generated over 1, 5, and 10. Of course, we're public market investors, i.e. you and I, the audience. So how does the listed kind of PE peer group kind of stack up to that? Well, the LPX Europe is an index to kind of track that. And as you can see, listed PE provides a decent look through to kind of global PE performance. And then finally, how does OCI compare to LPX Europe? And as you'll see, quite favorably. In fact, it has outperformed it over those time periods. And then I guess most importantly is how has that then corresponded OCI's NAV performance to kind of share price performance? And there it is, tracked against the All-Share, and you can see that it's performed relatively well. The dip there is that kind of March dip in a period of relatively low liquidity when we went into the first lockdown, and share prices reacted accordingly. So let me introduce you to Oakley Capital. It's a mid-market PE where it manages a mid-market PE buyout funds. And what do we mean by mid-market? That's companies up to 400 million euros of enterprise value, and we invest down to companies of about 100 million euros of investment value. Kind of where do we make most of those investments? Well, it's heavily orientated towards Western Europe. We have a particularly strong track record in Germany, Italy, France, and Spain, and that continues to be a very important hunting grounds for us, where opportunities lie, and also where there's less PE penetration in general. And then our sectors that we focus on is technology, education, and consumer. To give you a little flavour of what we mean, they're quite broad churches, those three categories. In terms of technology, we started life, you have a heritage in web hosting and telecoms, and that's evolved into a successful track record, kind of backing technology-led kind of business service solutions, and also digital services. And so that is like kind of online classified or price comparison websites. In consumer, that is investing in kind of brands that have a lot of history and incredible following, and it's the opportunity to take those brands into kind of new verticals or into new channels. And then finally, education. We invest across the full gambit of education, from kind of premium schools to tertiary education to after school kind of tuition and to career-based and online education. So the Oakley Advantage, as the box says, is that the point, and I apologise in advance for no doubt the repetition of this particular phrase, but over 70% of the companies in the portfolio, and there's 18 currently, deliver their products or services digitally on some kind of digital platform. And as you can imagine, that has put us in a very strong position over the last year, and it is a great and recurring source of value growth for us. And then just as interestingly, I think this kind of really plays to the sustainability of the performance of the funds, is that over 70% of the businesses that are currently in the portfolio have some kind of subscription model or recurring revenue that means there's kind of great visibility to the performance of those companies. So how does Oakley kind of do what it does, and what's the kind of secret to its origination, and how does it unearth value? Well, I think there's one takeaway about Oakley Capital, is its relationship with business founders. It was founded by an entrepreneur, a business founder, a gentleman called Peter Dubens, in early 2000s. And whilst the company is, there's now, 7 partners and, a 40+ strong investment team that's grown since then, at the heart, at the nucleus of the business, is still this idea that a business founder set up a PE firm, the PE firm that he always wanted as a financial partner when he was establishing, growing businesses. And unlike a lot of PE firms where a business service professional, an accountant, a lawyer, a financial services professional has founded the business, this is a very notable difference in the way that we approach partnering with companies. And as a consequence of that, not only do we attract very successful business founders to the organization, but also we go on to have repeat relationships with them. And we have over 20 business founders that we've backed, in some cases 3 or 4 times. And to really emphasize the strength of that relationship is that those business founders, post-success with us, have gone on then to invest themselves directly into the funds. And of the funds we managed, 200 million euros of those have actually been committed by the business founders that we have backed. So there's this wonderful alignment of interests, and it really drives and incentivizes them to find new opportunities. And frankly, it's the one thing about any investment that you have to get right before any other, is quality management to back. And to that point, on average, in a PE investment, in 50% of cases, management are changed, which kind of implies that there's been a problem. In the track record of Oakley, we have finished the investment with the management we have backed in 95% of cases. Now, just like any other PE firm, we do a lot of proactive screening and analysis. We do a team of 40, a team of 40 and AUM of 4 billion. So you get a sense of the level of manpower you need to invest within PE, particularly in comparison to maybe public market funds. And they do a lot of work around the sectors that we understand and know, and particularly looking for adjacent opportunities and most notably bolt-ons to the companies that we've invested. We are particularly focused on or are happy to take advantage of complex situations that might be, slightly messy share ownership or a carve out from a bigger parent. What's notable about that is, particularly in the lower mid-market and the mid-market, particularly with the level of complexity we're working with, we are not coming up against the larger global PE funds. In fact, I've had it described to me that Oakley essentially is, finds, develops and grows opportunities that are then attractive to the global PE firms. And in fact, the majority of our exits over the last few years have been to the likes of CVC, TA, EQT, to name a few. And so most notably, over 70% of the transactions that we have been involved in since our inception, over 70% of those have been uncontested, i.e. those investments have not been part of a competitive process with an intermediary that has prepared a business for sale. And that's incredibly important when you think about how you unearth value. It's very hard to unearth value in a competitive auction, and it's very hard to have some form of information advantage which makes it worth our while competing in that way. In 85% of cases, we are the first primary capital, the first institutional private equity that has invested in that particular company. And to kind of bear out the stat on carve-outs, over 40% of our deals involve some kind of carve-out. So to talk through maybe some of the themes, investment themes that particularly attract us, or where you might imagine us making further investments across those sectors. We're certainly, as a result of recent events, certainly not moving outside of our frame of reference and are sticking to our knitting. Let's talk first about the digital revolution. It's one that we're all very familiar with, but just in terms of how we see that proposition. And it's very much about, for the first time, companies being able to own the customer and market efficiently to that customer. And as we're very aware, most products and services, as consumers that are aware of, have depended upon some kind of physical, or broker or agent or a physical network or a wholesaler in order to deliver that product or service to the customer. And of course now, as a result of the boom in D2C, and particularly of digital platforms, that product or service can be delivered directly to the customer without the friction, the cost of trade of having to use a kind of third party or a kind of physical network. And the shift in margins as a result of that is enormous. If you take the typical margin for a retailer of an item, if they're lucky, it's kind of 15% EBITDA margin. A wholesaler might enjoy something more like a 20-25% margin. D2C, it's 35%, and so that is a kind of game changer for a lot of business models. Secondly, it's the first time in which we've really been able to invest in this space and know that we can accurately predict the returns that we get from marketing, which is enormously important, because up until now there's been a real kind of spray and pray kind of element to marketing, which has been via kind of TV or print or radio. Now there's very effective measurable digital marketing, and we can really calculate the returns we're getting from every pound spent or dollar or euro on marketing. Most importantly, it's giving the companies that we own the power of data. It's the most valuable commodity on the planet right now. And finally, companies can understand who their customer is, how much they're worth to them, how much they should pay to acquire them or retain them, and their ability. They know exactly what they buy, when they bought it, what they responded to, and how to kind of upsell and the rest of a product or service portfolio. And to that end, the winners have been, as you can imagine, the digitally native, those that have existed in this particular world from the start. So they've been developed and groomed to really kind of take advantage of the D2C opportunity. It's quite hard, as we've discussed, or we've kind of slightly highlighted on, in the education sector, it's very hard to switch immediately to an effective digital solution. To give you some sense of the winners, those digitally native winners and the ones that we have in our portfolio currently, we have a guided fitness app in Germany that is particularly focused on the kind of female exercise segments called Gimondo. There is the price comparison website, Facile, which is the leading platform of that kind in Italy. And we have Career Partner Group, which, as I talked about up front, is one of the leading German universities and is the leading online German university. Let's just talk a little bit about Career Partner Group. I mean, for a number of reasons worth focusing on, because it's been one of the biggest drivers of performance over the last year for OCI. So the more understanding of it, the better. But just in terms of the proposition and the difference between IUBH, being a dedicated online platform for learning versus a traditional university, and the contrast between the two is really stark. I mean, most universities essentially are not focused on the end consumer for either their reputation, for their performance. Most of that is built around kind of traditional their focus is on research and that developing their reputation. They're very much focused on a classic kind of classroom model, and they're elitist and they're selective in the number of students. They don't have flexibility around the courses they can provide or the number of the students that they can work on, and they depend upon maintaining their reputation rather than to attract students, rather than the kind of host of ways to attract any user or consumer of a product. And so if we take IUBH in contrast, it works, it's all focused around customer satisfaction and producing a product and a platform that is best suited to a student's needs. So it's not necessarily scheduled lectures at particular times when it suits the university. It's all around the ability to learn and to educate in the most flexible way for a student. And it also enables kind of career-based dual study learning and the much more progressive ways that students want to take, focus on tertiary education. It uses a lot of Google Analytics and online data to understand the kind of courses that students want. It now offers over 100 courses, so incredibly flexible to that extent. It enjoys much higher margins as a result of the way it deploys its learning, and it's very customer centric. And to give you some sense of its success, when we acquired this business now nearly 3 years ago, it had 15,000 students. And I should say in Germany that the online education model is relatively young. It's not as mature as it is in other parts of Europe or the US. But it had 15,000 students, and today that number is now over 60,000. It was doing 16 million of EBITDA. It's now left 2020 doing a run rate EBITDA of closer to 70-80 million of EBITDA. So an incredibly attractive prospect, and will no doubt be one of the companies that drives OCI's NAV over the next 1 to 2 years. Another important area for us is kind of repeat plays in different geographies. I've highlighted the fact that we have particular expertise in investing in online platforms. And here we see on the kind of maturity curve, the kind of big players in the classified markets. They are names that you'll be familiar with: Rightmove in the UK, REA in Australia, and Immobilien in Germany. And these are operating in mature online property classifieds markets. And they're supported by high levels of connectivity, high levels of digital adoption, and large underlying market sizes. The opportunity that we've been able to explore, and we've done this successfully in Germany, which was less penetrated and mature than the UK, and then subsequently in Italy, and now we've gone on to Spain, all of which are progressive steps behind the kind of UK and the more developed markets. And so here on that curve demonstrates where the market leaders in other jurisdictions are in terms of the kind of monetization. there are many times less, 100 times less the margins that they're enjoying at the moment. And in terms of the kind of agent penetration, they're at kind of Idealista in Spain might be at 60-70% kind of agent penetration, whereas you might find a Rightmove is at 85% agent penetration. The other thing as well is in terms of agent spend is probably double the level it is in the UK as it is currently in Spain. So we've had the opportunity and the insight to be able to buy into these companies as they enjoy that increased penetration, increased margin as they move up that maturity curve. And you'll see that as a recurring theme to us. And in fact, that we sold Casa to EQT and we're able to have the opportunity to take part in Idealista that has kind of rolled up a number of those classified platforms in Southern Europe and is now the leading player in Southern Europe in that space. And then to give you a sense, before we move directly on to talk about OCI, to give you a sense of the level of prospects that Oakley Capital is seeing and the level of activity it's being able to maintain despite the events of last year. 2020, you'd have seen us announce this recently. It's a quick summary of the activity that we've enjoyed over the period. It shows that we've been active in not only doing bolt-ons to existing businesses, but also finding new platforms to invest in. And also, and just as importantly, the level of realization, the level of funds flowing back to OCI has been 341 million as a result of 4 exits the last 12 months and 4 refinancings. So what are the prospects? What does the pipeline look like at the moment? Well, incredibly, we have over 150 opportunities that are currently under review. I mean, to give you some sense, you can see the number of deals. We made 8 acquisitions last year. So to have a pipeline as big as 150, kind of shows you that we have a large pool to consider at this point in time. 40 of those are immediate prospects. So, I mean, to give you a sense, in some cases, we can be working with the management, sharing information or getting to know them over a number of years. In some cases, up to 3-4 years before we're actually making an investment. We have to either be patient in order to wait for them for the right time where they might need a private equity backer, or we're waiting for the company to develop to the stage when it's profitable, established, and maybe then is more suited to investment for us. Most importantly, of that pipeline, 70% of those opportunities are proprietary, i.e. they're ones that we've essentially sourced through our own network and relationships, as opposed to an agent or an intermediary, putting together a sale process in which they might advertise it to any number of private equity firms. The kind of COVID catalyst, I guess the interesting to consider is, so what is that pipeline made up of? Is this distressed companies that have really, fallen on difficult times and therefore need support? Or are they the kind of runaway successes that have kind of done incredibly well last year and now are looking to kind of sell? And I'd suggest it's neither of those two extremes. There has been a COVID catalyst, though, in terms of producing more opportunities for us. And I think it's kind of, it's not as direct as necessarily businesses that have been obviously impacted by COVID, but it's been as a result of maybe with the uncertainty that COVID has created, then there is the desire for maybe greater support or security to be part of a bigger firm. It's also accelerated some business models. So they're now thinking about the next stage of growth and supporting that, whether that is M&A, expanding into new verticals, internationalization, the kind of things that that Oakley can bring. And also, and more subtly, look, I think, many business founders are considering the fact that there's going to be potentially a significant rise in CGT, and that in itself is producing a catalyst for conversations to take place sooner than maybe we had anticipated. So moving on to the final section of this presentation. Check how I'm doing for time. I'll speed it up slightly. So this is an overview of OCI. Here you see the 728 million of NAV divided down into the 3 different asset types. So we essentially commit much of our capital into the funds themselves. And 335 million currently of that, well, actually at the year end, it's actually increased since we invested in Idealista, sits in the funds. We've made some direct investments, both debt and equity, into the underlying portfolio. I should state at this point in time that that was a historic decision we made in order to kind of reduce some of the cash drag that we had in early years. We are unwinding that position and really very much focusing on the funds. The funds generate for us a net of fees IRR of 25% per annum. And so that is really where we want to kind of focus our attention. The cash is notably high. It was as high as 38% of NAV in 2020 because we made 2 very large exits at the beginning of the year in WebPros and Inspired. It's a nice defensive position to be in as Oakley looks to deploy funds into a very interesting and opportunistic time. And it's good that we've got this kind of sizable cover of our commitments that I'll talk about in a second to the funds. But it's much higher than we'd look to retain. I mean, our long-term average is more like 15 to 20% of NAV. So what you should see in the development of this NAV pie chart is essentially that grey area taking up, kind of up to 80, 85% of that pie chart, really helping OCI to leverage from the performance of the funds and a slightly less level of cash. Here's the commitments that I talked about, and this is really the essential to us, kind of in our ability to continue to participate in the performance of the funds. In the dark green is the level of capital that is still outstanding that we think is going to be drawn. I would say, although it's a large number, that 534 million, because of a range of reasons, there's a facilities at the fund level, and you get recycling of capital sometimes when you sell out of an investment, is that typically, I think historically, Oakley has only ever drawn circa 50% of commitments. So you're very rarely drawn on your full commitments. However, we have a comfortable level of cash cover to the level of commitments to the funds. So here is a snapshot of those 18 different companies and how they sit across the 3 sectors. You'll see it's relatively balanced across those 3 sectors. I will draw out 3 common characteristics of those companies. They are, 1, typically a market leader in a particular niche. 2, that niche is enjoying some kind of structural tailwinds. And thirdly, as highlighted earlier, over 70% of these companies are enjoying some kind of subscription or recurring element to their revenues. And to give you a very brief example, Facile, online comparison marketplace in Italy. It's the money supermarket of Italy, if you like. It's the market leader in that space, particularly in car insurance, home insurance, and personal finance. The tailwind is the low adoption of that model. So compare UK to Italy. In the UK, 70–80% of all car insurance is arranged online, via comparison sites. In Italy, certainly when we bought it, it was 12%. So you can see we're not making a macro bet on Italy, far from it. We're just, and we're already seeing the greater adoption of these models as we've seen in lots of other jurisdictions. And then finally, the recurring element, where they receive an annual recurring fee from the product providers that their customers renew with. So COVID impact. Well, as you can imagine, we talked very much about digital D2C software businesses that have essentially, kind of proved to be very robust and with sustainable revenue streams, such that the lion's share of the portfolio companies have been unaffected negatively by COVID. So you'll see there the kind of selection of companies we've added to these recently. So the numbers increased as we bought NXT, Windstar, and Idealista, all of which have performed well this year. So the portfolio has grown in that particular area. But those companies have kind of grown at or better than their expectations, and they are the kind of businesses that you would expect to do so. Business service software, web hosting, online consumer platforms, and education technology. Those that have had a modest impact are those that have been kind of a lockdown impact, and they haven't necessarily, that's impacted some element of the business. So, for example, in the case there's 3 examples there, it's really new business wins or enrollments that have been impeded by social restrictions and have affected kind of the telecoms and education sectors. But when we've seen, as soon as we've emerged from lockdown, we've seen the run rates return to those businesses pretty quickly, although they haven't made up the entire ground that they may have lost as a result of a lockdown during the period. And then finally, in the third bucket of those companies where there's been significant impact, they're limited in number, but the disruption's been material to their operations because they're businesses with physical footprints, they're direct-to-consumer models, and they are continuing to be impacted by the kind of repeated kind of Europe-wide lockdowns. So the OCI stats as they stand, thanks to the update that we put out recently, we've got 728 million of net asset value. That translates to 403 pence of NAV per share. And that was an 18% NAV return, total NAV return last year. And that's very much in line, despite the events of last year, that's very much in line with our 5-year kind of CAGR of 17%. The market cap is notably lower at 531 million compared to that net asset value, and the share price today sits around 294. There's a particularly important stat that I'd like to raise, which is that on average, whenever we exit a portfolio company, we've done so at a weighted premium of 44% to the book value. So not only do you trade at a discount to the current value of those assets, but when we exit them, we on average achieve a 44% premium to that value. You should also note that actually, if there's any concerns around the conservatism of NAV, and that maybe hasn't put that to rest, but another thing to look at is, or to consider with PE, is that there is no incentive for a PE manager of pushing valuations forward. They only get a performance fee based upon the exit. So the interim valuations, they're actually, arguably not incentivized to push them too aggressively. So they're very reliable as a result. And secondly, the management fee is very much upon committed or investment at cost. So again, there's no benefit to increasing the value or the perceived value of the fund. And then to conclude, how does that performance kind of compare to our peer group? Well, here over 1 year, you see us kind of standing kind of toe-to-toe with HG and Apax. Over 5 years, it's only kind of 3i and HG that sit ahead of us. There are years in which we, kind of over 2 years, we're ahead of the pack. But essentially, we've now established ourselves as being a consistent performer against a very high quality PE peer group. And I hesitate to kind of show the next slide because it's clearly trading at a significant discount. It's on the basis of the NAV growth that I would encourage anyone to invest in OCI and the quality of the portfolio companies. However, most notably, OCI trades at a significant discount compared. The only those that sit around it with a kind of a similar or bigger discount are those that are in runoff or in a very different situation from us. So kind of key takeaways: over 70% of that portfolio kind of delivering their products or services digitally. The average EBITDA growth in 2020 of that portfolio, of those portfolio companies, was about 20%. Now, actually, we've averaged a lot higher than that. So that is a kind of COVID impacted number. We've historically been more around the 25-30%, but I think it's a mark of the quality of the portfolio that it's still grown at that level. That annualized rate of return, that I think we are now proving we can sustain, and not only sustain, that the Oakley origination model will enable us to continue to kind of repeat that long into the future. And then in terms of our next time you'll hear from us, and we'll provide more metrics around those portfolio companies, is on the 11th of March for the full year results.
Stephen, thank you. Thank you for that very clear and detailed presentation. And I guess congratulations for delivering such consistent NAV growth over such a long period of time. So we're now going to take questions from the audience. We've had a few coming ahead of time, and we've had a few during the webinar itself. If you do want to ask a question, there's a Q&A box at the bottom of the screen. If you put them in there, I will ask those to Steve now. We've got quite a few, Steve, so I'm going to ask you if you'd be relatively concise, so we can get through as many questions as possible. First one, I guess, is looks like a little technical question, which says, can you clarify with Halifax share dealing why they no longer allow dealing in the OCI shares?
Yes, absolutely. There's two platforms, Barclays and Halifax, that don't allow dealing in shares listed on the specialist fund segment, which is where we're currently listed. So we weren't able to make the move to premium list immediately because of, we were told, fund concentration at the time. And so we made the first step to the SFS, but the long-term intention is to move to a premium list.
Okay. I think you covered this in your presentation, but just to clarify, why are some investments made into Oakley funds and some made directly into companies?
Yeah, absolutely. So firstly, when particularly early on when we had a lot of cash as we were first trying to deploy, it was a way of avoiding cash drag. So we particularly focused on providing debt to the portfolio companies at particularly attractive levels. So these were companies that maybe needed short-term financing, like mezzanine type lending, and we targeted, kind of interest rates of kind of 10% or more. Secondly, the other opportunity was when the funds came to the end of their life, and there was the rare opportunities for us to retain a stake in a company that was particularly high quality. And so we were able to do that when the funds kind of sold down. Those opportunities particularly are rare. We were successful in doing that with Inspired, for example, but there aren't many opportunities like that. The opportunities generally are scarce. It's not a particularly recognized way of doing having a co-investment strategy. And in order to achieve the kind of higher rates of interest that we were interested in, then we were lending to the companies with constrained balance sheets that were attempting kind of more ambitious strategic turnarounds like Time Out and North Sales. So the strategy, I think, was proving a bit confusing and kind of raising some concerns about conflicts of interest. So I guess in short, we've decided that to take the view to wind down those positions and invest exclusively in the funds kind of going forward.
Okay, that sort of brings us neatly into a question about funds. It was a question that came in ahead of time and something similar that's come in during the webinar itself. So one of the questions is, Fund 3 sold its holding in WebPros and Fund 4 invested in WebPros. Can you explain how that works? And I guess the related question is, there are a number of PE houses who have recently sold a holding in one fund and bought the same holding in another. What's the Oakley policy at that?
Yeah, absolutely. I mean, one of the restrictions of private equity is that although PE takes a long-term investment view, funds have a limited lifespan, and so you're forced into exiting at some point. I mean, the average Oakley hold, I think this will grow, but the average hold is around 3 years. And I think actually it's typical that maybe in the early life of a PE investor, there's slight pressure to exit earlier than they might ordinarily, because they're looking to get a realized performance that helps them build a track record and ultimately to kind of raise new funds. So as I say, I suspect that average hold period will grow. There's also a point where we have to recognize that a company reaches a certain scale, needs more firepower or specific expertise that we maybe cannot provide alone. So in short, for those reasons, funds have kind of exited, had to be in a position to exit an investment. But because of our knowledge of that business, we still think it's an attractive opportunity. We've taken the opportunity to take a minority stake in that business in a subsequent vintage fund. And your question's right. We've done that on a number of occasions. We did that in WebPros, that was held in Fund 3 and is now held in Fund 4 alongside CVC. We did that with Inspired. That went from Fund 1 to Fund 2. So a separate holding, but a minority stake, but also taking advantage of a different phase in the growth alongside some larger PE houses. So in Inspired, that was with TA and GIC. And then in Fatulay, we've also done that Fund 2 to Fund 3. Again, I think in all those cases, we're wishing to continue to back businesses that we have invested a lot of intellectual capital in, and we believe there's still a great opportunity for the next phase of growth, and for the next funds to participate in that has been a real successful strategy for us.
Okay. Got a couple of questions around sort of the share price and NAV, discount to NAV. The question really says, why do you think it's so large, and what's the company doing to have this reduced? Is there a policy here? Would you just like to comment on the discount?
Yeah, absolutely. I mean, an understandable question. And look, I can speculate. We could have an entire whole other hour discussing, kind of the valuation for any business and why it sits at the discount it does, and why it's stubbornly remained the case. Look, actually, if I don't mess this up, I might suggest just showing a list of reasons that we certainly identified a number of years ago. So let's see if I can achieve this. Hopefully that appears on your screen at the moment, Alex.
Yeah, we've got that up now, Stephen.
And look, I'll flick through this, but basically we met with a whole bunch of our shareholders, senior institutional shareholders in 2017, and we put together a list of all the things that we thought essentially were needed to be improved about the governance of the business, and were contributing essentially to a discount. Now, I don't use this slide as much now, in fact, rarely, but I think it talks to some of the reasons that a discount has existed, and its possible echoes of the past still sit on the shares. The key crime that the company committed historically was that it issued shares at a discount. We can talk about the reasons for those, but essentially we've stopped that process, and while it was done in good faith historically, we've made very strong public statements that we'll never do that again. The other thing that was felt is that this concern around the conflicts of interest between Oakley Capital and OCI, and was OCI being managed for the best interest of Oakley Capital or for its shareholders? And one of the problems there is to kind of really assure people that it was the right side of that particular argument, was that Oakley Partners and the board didn't really have much of a shareholding in OCI, so were their interests really aligned? In 2017, that shareholding was almost zero. Today, it's now over 11%, and that was kind of a stated target, but it's a number that continues to grow. We were pretty random in terms of the way we return cash. We have a dividend, it's modest, and we've only ever retained it, and we wouldn't set expectations that it is particularly set to grow, but we were able to retain it in a year where others maybe stop dividends or stop guidance. Most notably though, and this really talks to kind of what we can continue to do, we spent over £40 million in buybacks and cancellation of those buybacks, and that's certainly a much more significant program than we've ever done in the past. Greater disclosure kind of sits on a much broader term, but it essentially covers off IR. We engage now with more investors into events like this than we did in the first 10 years of OCI's life. So there's way more engagement. We turned over the register nearly 1 times in a 2-3 year period, which is, for a £500 million company, is no small feat. We also provide a lot more in terms of our reporting standards. We kind of try to be blue chip and best in class in terms of exposure for knowledge about the portfolio companies, access to the CEOs, capital markets events, webinars, the list goes on. Share price liquidity and shareholder concentration has genuinely been a real problem for the business, and certainly who it's been perceived to be associated with. At one stage, the top 10 shareholders were 95% of the register in 2016. And most notably, Woodford Investment Management and Invesco combined were 55% of the register only 2 years ago. And when I did the half-year results, and I probably did, I don't know, 20 institutional investor meetings, at least 1 in 3 told me the biggest reason for the discount was perceived overhang. And in particular at the time, Woodford were not on the register, but Invesco were, with the impression that Invesco that were a natural holder of the shares and that they could be up to 20% of the register. As of December, they are no longer a holder. And the liquidity is significantly improved as a result. We were AIM listed and we are Bermudian incorporated. Now, neither creates an impression of quality. It may be entirely cosmetic, but that is the case. We've moved off of AIM. Now, we haven't made it all the way to the main list yet. We've covered this earlier, but we obviously intend to. Our Bermudian incorporation is a heritage thing. Our board are offshore and a number of whom are based there. We believe it's a high quality and independent board. There's no intention to immediately change that. But the board composition up until 3 years ago had been there some years, kind of 10, 11 years and needed some refresh. So in terms of, Alex, in terms of kind of other reasons, we could kind of continue. That direct debt confusion is a part of it. And also Oakley Capital is very much associated with time out in the press, principally because it's the largest and it's the only real UK brand in that portfolio. So as a result, the press tend to kind of say Oakley Capital manager a timeout. And clearly, of all the assets and the kind of businesses we've described in, it's described, kind of timeout is not typical, and it's only, 6-7% of NAV. Have I spoken enough on the discount subject?
I think you have, and you've also answered another question which says how big is a timeout as a percentage of the overall NAV, and I think you said 6 or 7%.
Yeah.
Let's talk about another company in the portfolio, North Sail. Question really, can you update in terms of current trading, outlook for regattas to 2021 and any recent changes in the debt structure? Also, has there been any policy instituted so that one holding would not become as large as North Sail, where debt and equity investments become, I think they say, as much as 19% of NAV last year? I don't know if that's right, but what percentage of NAV does it account for now?
So in terms of North Sail, the question is correct. It was an incredibly disruptive year. For those less familiar with North Sails, it essentially dominates the sailing industry. So for premium sailing, premium sails, and also bespoke kind of mast and booms, everything kind of the deck upwards. There's also an action sports business, which is kite surfing and sailing. And the opportunity we saw was to really kind of stretch the brand into other areas, to really take advantage of the apparel opportunity as kind of north faces to mountains. Then we really wanted to develop technical kit for the oceans, and also to really grow that action sports kind of segment. Now, for various reasons, last year with no regattas, sailing's like, Formula One car wheels or razor blades. You need to replace these, kind of expensive, high performance bits of kit kind of once a year. You're talking about £1 million sales. And clearly with no regattas or events taking place, then sales don't need replacing. Now, the outlook for this year is that, it's the expectation that sailing events and regattas kind of will return. Now, of course, the kind of, emerging from lockdown is particularly hard to predict, but, kind of anecdotally, as we have kind of partners operating or individuals operating out of places like Madrid and Milan, the level of containment that's currently in place in those cities is much below ours. There's essentially a 10 p.m. curfew, but life is, pretty much as normal up until that time, which would give you some sense that actually in most regions, come the kind of sailing season, that will, kind of return to some level of normal. Where we're really seeing a boost, in or out of COVID, is on the kite surfing and the windsurfing. That really is, solo action adventure outdoors type sport has really taken a boost from that, and our expectations for that business actually were exceeded last year, and we expect that to continue. And the real progress we've made is in apparel. We got apparel wrong. We backed the wrong person who built a very expensive network of kind of retail stores. And we need to reverse that. We did so by bringing on a gentleman called Vicente Castellano, who has an incredible track record and led Hackett and Pepe Jeans, to name two. And he's brought that business back to profitability. And also, you know, the early signs for the kind of orders, wholesale orders in, you know, for the future seasons look very positive. So the early signs are that we would expect North to return to the levels of the cash cow sailing business, but also the growth in the sectors that we're particularly attracted to. In terms of, look, we've been very clear about the fact that whilst we made direct investments, you know, in companies like this, and particularly debt investments into a company like this for good reason, and, you know, they generate a 10% return for us, we're very clear about the fact that this is not something we intend to continue. And so this is, you know, we're winding down those investments. It's taken us a year or so longer than we anticipated because of COVID. But, you know, we'll look to kind of refinance those businesses, you know, when they're back to kind of full strength, and exit those direct investments when we're allowed to. And, you know, there is a clear statement understanding by the OCI board that you know, they will not be looking to instigate new investments in that in a direct nature again. Okay.
We haven't got much time left. We've got a lot of questions, so I'm going to try and run through these quite quickly and ask you to give some sort of short, sharp, and punchy responses, Stephen, if that's okay. So here we go. OCI has a very high percentage in cash right now. When do you see this being deployed?
Over the next 2 to 3 years.
Looking at your portfolio, which one of the portfolio companies has the potential to have the biggest impact on NAV performance?
Career Partner Group.
Okay. Should there be a strong correction to tech companies on public markets worldwide, how might this impact you?
Yeah, look, I mean, there has been already, and we can't fully reflect what we think you might achieve at an exit, because who knows in what environment we exit. But I think if you had to sell this portfolio now, the kind of premiums we would achieve based upon the appeal and the attraction of, you know, tech, software, digital business, ed tech businesses is incredibly high.
Okay. Looking about you commented before about vendor exclusivity. Why would a putative vendor want to give you exclusivity rather than go to some sort of auction?
Because in most cases, they're actually willing to, they want to stay in the business. So this is actually, they're not necessarily exiting at this time. So you know, they're looking for a partner, and they're not looking to necessarily maximize their entry level, firstly. Secondly, you know, we're often talking about opportunities where the business isn't prepared for sale. You know, it's not in the situation where it can sell, maybe because it is part of a larger partner, maybe because there is a disputed shareholder structure. You know, it's not in a situation where it can be part of a competitive process. So it needs someone who is willing to kind of roll up their sleeves, maybe create counts from first principle, and ultimately to take them to a position where they could be part of a competitive process in the future.
Okay. Going back to the shareholders, in December, OCI bought back stock, and that coincided with Invesco's sell down. Would you say that current shareholders are content or of Invesco's disposition?
Content.
Content. Excellent. What's the staff turnover like at Oakley Capital, or do people stay forever?
There is a tendency to stay forever. I mean, there's very, very little turnover. I can only think of one or two individuals leaving the firm for personal reasons over the last 3 to 4 years.
Okay. Another question on shareholders. Do you know what the percentage of shares are held by retail? And do you have plans to grow this? Do you have a target figure?
Yeah, it's hard to get an accurate number on this, Alex, but it was about 14% in 2019. It's about 20% in 2020. And, you know, we target at least 25% in 2021. I mean, retail wealth, private wealth managers, family offices, are the natural fund of funds, the natural owners and holders of OCI. Those that this is their way to get access to kind of private equity performance. And it's certainly what we'll be putting more effort into over the course of the next 12 months.
Okay, I think we've got time for one more here. So one reason for your large discount could be that OCI spreads its investment skills over too many sectors. Why not just focus on the technology investments where you've been doing really well?
Yeah, I mean, look, I think digital tech kind of pervades all three sectors. I take the point that the stock market doesn't deal with complexity or a wider story particularly well, and clearly HG is a very good example of a very focused we do business service software. Now it's across lots of different sectors, but it's a very clear message, and it's the one that the public markets have very much digested. It's not too dissimilar story for us. But look, I think it also gives us the flexibility to continue to find value. If a particular area of technology gets overheated, do we really want to be held to ransom by a particular sector in a particular niche? I think if we can continue to create the level of returns that we're generating across sectors, to that point, we would never have gone into education, which has been one of our best performing opportunities. And yes, Career Partner Group has a tech element to it because it's an online business, but is essentially an education business. And I think we wouldn't want to constrain ourselves and miss out on those returns by being too narrow.
Stephen, thank you very much. I'm afraid that brings us, we're running out of time. That brings us to the end of today's webinar. Thank you to everyone for attending. Thank you, Stephen, for answering all those questions so concisely. Much appreciated there. As you exit today's webinar, there is a survey for you to complete. Only takes a couple of minutes, so would really appreciate it if you could complete that survey. I know management find that really helpful. If you've had any questions that haven't been answered, please send them to info@yellowstoneadvisory.com and we'll try and get back to you on those. I'll just flag up one thing that's coming up, which is our next webinar is on Wednesday, March the 10th, when we've got Diversified Gas and Oil. We'll be presenting their full year results, all details on the Yellowstone Advisory website. And just to say a final thank you for myself and Stephen for everyone attending today. So thank you and goodbye and see you soon.